Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk this afternoon, we have Eliasaf. He's founder and managing partner at Northwind Group. SherAfgan Mehboob, he's the CFO and head of corporate development at Tillman Digital Cities. Jed Resnick, CEO of Douglaston Development, and Graham Sowden, chief investment officer of RREAF Holdings. They join me to discuss 2024 outlook in residential and commercial real estate, the impact of hybrid work models, and lending alternatives. Gentlemen, it's great to have you with us. Welcome to Trade Talks. I want to go around the table first just to kick this off with some of the most discernible trends that you've noticed in 2023. Ron, what really stuck out to you this year?
So 2023 was definitely defined by the bank kind of taking a huge step back in lending following the collapse of Signature Valley, First Republic, and less lending activity by those regional commercial banks and more heightened larger activity lending from private debt funds like ours and others. And in general, we've seen less deal volume happening, a bigger bid-ask spread between buyers and sellers, and a huge question mark around values of commercial real estate in general. I think those themes will probably remain in 2024. A day ago, I would say that a big challenge around recapping, that might be turning now as we've seen the indication on rates actually starting to go down. Strong indication from the Fed, about 3 step downs, 3 25 bip step downs. That is something the market already kind of predicted, but it has now met a real affirmation from the Fed. Yeah. So that will definitely have a huge impact on real estate in general.
Yeah, and you know what's so interesting, SherAfgan, we really are at historical norms in terms of interest rates. It's just what we saw in 2022 and 2023, the velocity of just how quickly they raised it. I mean, the affordability picture, I think, was one of the other big stories in 2023.
Yeah, so Tillman Digital Cities is focused on in-building connectivity and providing it in all of its various different formats. You know, based on what interest rates did kind of across the board, you know, both to the real estate market and kind of all the other tangential players around it. And one of the most interesting themes that we saw was that carriers were no longer willing to take the economic cost of deploying in-building connectivity, so their signals could propagate across large venues within real estate. And we think that theme is going to continue well into 2024 and maybe here to stay, where the cost of all of that in-building connectivity will actually need to be borne by the real estate owners.
Yeah, and Douglaston, you're largely exclusive to the New York City area, which of course is its own universe when it comes to real estate. What are some of the trends that you noticed?
Well, I'd like to piggyback off of something that Ron said, which is absolutely we saw a pullback in bank lending. We saw spreads widen out. We saw loan to cost on new construction. The amount that the banks were willing to lend against a project definitely got a lot more conservative. But the other piece of that same trend is that the institutional equity players turned themselves into preferred equity players and then turned themselves into mezzanine debt providers because they could, right? They're earning the same net returns making mezz loans that they were earning taking last dollar exposure in joint venture equity. So that's a huge sea change. It means that if the same shop that would have been pari passu with you on a 90-10 or 80-20 basis to fill the capital stack out above whatever debt was available from whatever source, if that same shop is now saying, well, we can only go to 85 cents on the dollar in your capital stack, and you need to be fully subordinated. All of a sudden, if you're a 60% loan to cost construction project and you're 90-10 on the equity with a private equity shop, you're putting in 4% of the total capital as the sponsor. If that goes to 15%, that really starts to stretch the ability of many sponsors, and that's part of the slowdown in deal activity. That's driven in part by interest rates. It's in part by uncertainty about price discovery, and in part by a dramatic expansion of capital requirements, and people can only do so many projects.
And to add on that, it's created much less new projects starting, and there's a huge supply issue in New York City. Definitely, almost nobody started a new project. The projects we financed are projects that started pre or during COVID, and there is a huge supply issue in New York City on residential.
And the other key trend, I think side by side with that, at least here in New York City, is that the fundamentals have never been better. our business is predominantly focused on multifamily rentals, and the fundamentals have never been better. Employment is fine. Rents are higher than they were before COVID. Occupancy, I've never seen 100% occupancies before in my career, and that's where we are. But at the same time, there's this uncertainty about what is all of that fantastic performance actually worth.
Yeah.
Right.
Tell us about some of the trends.
Very similar to what everybody's been mentioning. We, amongst many other things, we are large multifamily operators, owners operators, but predominantly in the southeast. But we're seeing the exact same things. I think we saw a big slowdown of new development starts, but there's a lot of units that are still going to be coming online. So it's really going to impact absorption in 25, 26, I think. But to piggyback off of what you were saying, obviously transaction volume has slowed significantly. There's still that wide bid-ask between buyers and sellers, not being able to come to terms with valuations on their deals. So,
Yeah.
Are you seeing markets in the Southeast that have less of an issue or that have actually oversupply?
I think it's been pretty consistent. I mean, you've got your Charlotte comes to mind, where there's a lot of deliveries coming online in the next 12 months, but very, very few new starts. So there will be supply issues probably in 25, 26. So.
And back to again where there's more demand than there is supply. And I mean, I just feel like even if we get interest rates down to that 4.5%, 5% level, which that's a big move from here, right? I mean, we don't want to go back too far. We've learned lessons from the 80s. You don't want to reverse course that quickly and have it on the downside as well. Affordability. I think it still comes back to that. And 4.5%, 5% doesn't even move the needle as much when people for nearly 10, 12 years were used to all this liquidity and essentially free money. So, I mean, just because interest rates go down, let's call it 75 bips in 2024, is that really going to open up the market that much?
It depends. It's very dependent. But we see a lot of what I call pop-up syndicator groups that kind of started coming out of the woodworks in 19, 20, 21, 22, when there was free money, basically. All of these groups that didn't have a whole lot of experience in owning and operating multifamily were, leveraging their properties to 80% with short-term fixed-rate debt, expecting 20% rent growth and the ability to flip out with a 1% prepayment penalty after 2 years. And, when rates went up on them, now they're sitting there kind of holding the bag, and they can't really refinance into this market, and they certainly can't sell without taking, a massive haircut.
Yeah.
So, for us, we've always, erred on the side of caution and locked in long-term fixed-rate debt, and we'll likely continue to do that going forward. The agencies have just kind of started pushing their 5-year buckets of money because I think they realize that, people don't want to take on that added exposure of having floating rate debt, but people also don't want to be locked into today's rates for 10 years. Mm-hmm. So, they're kind of offering that 5-year bucket as like a happy medium, and so that's kind of what we've been using financing our deals.
I feel like we learn leverage lessons every 10, 15 years. I mean, if you take a look at
and then forget.
History. Right, especially the past, let's call it 15 years. I don't think any of you have experienced a market that was as liquid and the cost of capital was as inexpensive as it was, and then you have a pandemic, which no one in the past 100 years has experienced. There's no risk modeling for that we were aware of. No one was thinking about that at the end of 2020. Excuse me, end of 2019.
And you're still going to see a lot of deals in 2024 that needs to get refied and that are simply underwater still. Even if rates go down another 1%, a lot of these deals will need cash infusion, new equity, and those smaller syndicators that
Right.
Graham mentioned will have a tougher time doing it. And some of the banks might still get hurt by those deals. They'll have to take it back or receive a price cut even on their loan basis.
Yeah, I think, everybody's been talking about, all of the opportunity that's coming. There's going to be, there's this huge wave of maturities coming, and, people aren't going to be able to exit, and you're going to, be able to buy at deep discounts, on the multifamily side. I think we're finally starting to see that come to fruition. We're also going to see a lot of those pop-up syndicators exit the space and, not really have the ability to continue, investment.
And that's been one of the headwinds as a multifamily developer is the institutional equity partners that we talk to for the last 12, 18 months have been saying, well, why would we want to build when there's all this opportunity coming in the multifamily space where we
Right.
acquire completed assets at higher yields.
Right.
And that's very hard to argue with.
50% of replacement cost, or whatever. So.
Let's talk about that a little bit more, the impact of hybrid work and return to office trends and so forth. Whether you agree with them or not, how is this impacting the commercial real estate space, particularly in large cities like New York?
Yeah, from our perspective, in-building connectivity has always been a theme. It's been deployed to probably single-digit percentage of large venues within the U.S. I think with hybrid work, you've got a large part of the workforce who, in working from home, has, really embraced technology, as have all of us, and have really assumed that connectivity is going to be available wherever they go. As they return to the workplace, the need to have connectivity really as a utility is becoming paramount. And then the themes that I was talking about, the first one being that the carriers are no longer willing to put up the bill for deploying that connectivity. I think secondly, something we were talking about offline a few minutes ago is that technology does change every 6, 7, 8 years. So how do you consume this utility? How do you really bring it online and have it there and really manage it as a real estate operator? It's really not, kind of the business you're in. So the shift that we see coming is, consumption of all of this infrastructure really as a service, so that you have somebody as a partner who is providing all of this connectivity as it evolves, so that evolved connectivity in a few years, where you're really kind of paying them on a yearly or a monthly basis, even as those requirements change, evolve, increase. We think in-building connectivity is going to be a theme that's here to stay, especially when you talk about new builds or retrofits. It's going to apply across the board.
Yeah. Well, when we think about commercial real estate, clearly, struggling within the real estate space, we have all this extra office space. Well, we have an affordability issue. We have homeless people. We have veterans that need homes. There's more people that want to come live in New York City and other areas than we have enough supply for. So why can't we just convert office space?
Conversions are going to be a huge theme. It's already starting, but I think it's been talked many times. It's complicated, it's expensive, and not every building is suitable for a conversion. So definitely in New York City, there's going to be, I know right now of about 8, 9 million square feet that's being converted. It's great, but it's going to take 4 years to get done, to get completed, and it's still a sort of a drop in the bucket, right? 9 million square feet is 9,000 units. The city really needs 100,000 units to be added to meet the supply requirements.
Or maybe a million, but it's very hard to do. It's very hard to find a building that's convertiable.
Well,
Right?
okay, for the audience's benefit, what is the reason? Is it because plumbing is different,
So
floor plates are
floor
different?
plates, airing lights, it's lighter layouts, so you can fit the apartments that are actually habitable in a competitive way versus new build.
It works. So many office buildings, particularly those built after World War II, were built with fluorescent light and with air conditioning, and where tenants wanted gigantic floor plates for their bullpen or their trading floors or what have you. But an apartment building, you can't really use more than 25 feet from the windows to the corridor, because you need light and air to live. So it's really hard.
So you've got units around the perimeter, and then you've got all this additional space in the central corridor of the.
And the other thing that because we've looked at we're looking at a lot of conversion opportunities. Every single week we get 2 or 3 inbound calls with somebody who's got an office building that's just perfect for conversion, except that they usually can't. The architecture just doesn't work. But the biggest problem is we're not talking to the right people. We're still talking to the equity. And most of these, it's so expensive to do that until we're talking to the debt holders, probably the senior debt holders who have taken control and understand the haircut that needs to be taken, there's just nothing. There's nothing we can do. We can't. The value doesn't add up.
Right.
Even as compared to just empty space that no one's occupying.
The cost to convert is,
Yeah.
I
It
mean,
takes
in a lot of
time
cases.
for the capital stack to realize where they are at and what's the real value. Everybody's trying to determine value. That office building, a B-class office building, might have traded at $500-600 a foot. The debt is at $200 a foot, and it might be worth $150 right now. That's the challenge, and it takes time to realize that that is the new reality.
And to work through.
Going forward, in the last few minutes here, I would even say 2024, but let's give it like a 5-year look. What do you think perhaps the city, whether it's residential, CRE, looks like?
I mean, I think as far as a former New Yorker, I think the city's going to do really well. I think New York City survives. As somebody focused on in-building connectivity, be it the managed Wi-Fi product, distributed antenna systems that allow carriers to come in, we think in-building connectivity is going to be a fundamental part of any and every venue type. And we think in a city 5 years from today, you're going to see in-building connectivity systems deployed across the board and consumed as a service, whereby you as the real estate operators aren't setting aside a couple $1 million to build those systems. You're relying on us and others like us as partners to come in and provide that service so that your tenants are fully satisfied. 5 bars and everything else they need to do, both for living as well as for work, is easily.
Yeah, I mean, because as the tenant or the end user, I don't care how it gets there, as long as it
Absolutely.
gets there and I have a seamless experience, whether it's my banking, my Wi-Fi, my lights working. I think that's that's at the end of the day. So, Graham, you coming from a different region, servicing a different region, what are some of the trends that you expect to see over the next 5 years?
I think we'll start seeing transaction volume creep back up. I think that we'll have a number of lesser experienced operators come out of the market. We own and operate in several different verticals, not only multifamily, but we also own beachfront hospitality, RV parks, or outdoor living is what we call it, and it's very high-end resort-style outdoor living. And we're starting to see a lot more engagement in that asset class because, as you guys said, people are able to work from home, work remote. We're seeing more people want to get out and travel. Buying a house is oftentimes pretty unaffordable, and I think we're kind of just seeing a shift, a cultural shift, really, starting really in COVID. RV sales through the roof. There's not nearly enough supply to meet the demand of high-end RV pads. So we're looking at some alternative type CRE investments that have historically been very fragmented, very mom and pop dominated, and bringing some institutional background to them. On the multifamily side, we're just now starting to see some of that distress that everybody's been talking about, and it's going to present extremely attractive buying opportunities for groups like ours and others that we're well prepared for times like these and are well capitalized going forward. We'll probably continue doing shorter term fixed rate debt from a financing perspective. But yeah, I think things are looking fairly good.
And speaking of multifamily, your outlook, Jed?
Well, I think it's, and we really are based in New York, but these themes apply across the country. I think over the next 5 years, we're going to see companies settle on a hybrid work model that is not work from home and is not full-time. I just saw a study from CBRE that found that companies that are full-time remote have 10% higher turnover than companies with any other work policy. So sitting face-to-face at any point ever gives you significantly higher retention of talent. So I think we'll see most companies land on some amount of in-office work. I think that means that the amount of office space that's obsolete and empty is greatly overstated, because whether you're in the office 3 days a week or 5 days a week,
Right.
you need a desk. And it doesn't change that much. So I think we'll see some flight to quality that allows commercial tenants to migrate towards better class office space. I think that probably leaves some holders of Class C space holding pretty empty buildings that will eventually reach a price point to get converted, and all of that just means, I think, great things for multifamily, because fundamentally we have a growing economy, growing population, and people need houses.
Right. The fundamentals have and I think will continue to remain very, very strong. In New York and the Southeast, we have tons of in-migration from really both coasts. But I think the population growth is just going to continue to explode.
All right, and Ron, last word.
I'll give two predictions. One, in the next 2 years, unfortunately, many foreclosures and defaults on Class B office buildings. On the other hand, we're going to have a huge affordability issue on rents in New York City. And if it's not solved by the city and we don't create 10,000 more or more of units, you're going to see an expansion of the metro area. You're going to see Jersey City, Newark finally becoming their own destinations. You're seeing it now in Long Island City, and the city will just expand because there's not enough units right now in Manhattan.
Well, I'll tell you what, as someone who moved to the burbs from Jersey City, it's pretty close to Manhattan prices now, so I think they're getting there closely. Gentlemen, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.